Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Janus International Group Inc. Annual Report. Janus International Group Inc. is a leading provider of building solutions for various industries. At its core, the company specializes in manufacturing and supplying self-storage, commercial, and industrial buildings across North America and internationally. The company's product offerings are diverse and cater to different needs. They provide roll-up and swing doors, which are essential components of any storage facility or building. In addition, Janus International offers hallway systems, relocatable storage units, and other solutions that enhance the functionality and efficiency of these buildings. Beyond its products, the company also provides cutting-edge technologies such as facility and door automation, as well as access control solutions. These innovations enable businesses to streamline their operations, improve security, and reduce costs. Overall, Janus International Group's comprehensive range of products and services makes it a one-stop shop for companies seeking reliable building solutions. The decline in Janus International Group Inc.'s JBI stock price by 23.49% over the past year can be attributed to several key factors. The company's financial performance in fiscal year 2025 was a major contributor to this decline. One of the primary reasons for the drop was the significant decrease in revenue, with a reported full-year 2025 revenue of $884.2 million, marking an 8.3% decrease compared to the previous year. This decline in revenue was not limited to one segment, as both self-storage and commercial and other revenues saw decreases of 9.7% and 5.1%, respectively. Furthermore, another source indicates that the company's revenue declined by a staggering 28.7% from $963.8 million to $686.9 million for FY 2025. This substantial decline in revenue had a ripple effect on the company's profitability, with net income falling to $53.8 million and adjusted EBITDA decreasing to $168.2 million. The company's underperformance relative to both the broader U.S. market and the U.S. building industry also played a significant role in the decline of JBI's stock price. While the U.S. market returned 15.5% over the past year, and the U.S. building industry saw a 21.3% return, JBI lagged behind with a negative return. These financial results indicate that Janus International Group Inc.'s struggles with revenue growth and profitability have had a lasting impact on its stock price. Janus International Group Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Janus International Group Inc. trades at a higher price-to-earnings ratio of 20 times and a lower price-to-book ratio of 1.41 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for Janus International Group can be summarized into several key points. On the growth side, the company has seen significant increases in revenue from its self-storage segment, particularly through new construction and the R3 product line. Additionally, the acquisition of terminal door assets has contributed to revenue growth. However, these gains have been offset by soft demand due to elevated interest rates and broader macroeconomic conditions. The decline in revenue can be attributed to several factors, including impairment of intangible assets, restructuring charges, and a decrease in foreign currency translation adjustments. The company's performance is also affected by industry trends, such as soft demand in the self-storage sector. Furthermore, the company's strategic decisions, such as expansion into new geographic regions, are expected to drive future revenue growth. In conclusion, the primary drivers of revenue growth or decline for Janus International Group are influenced by a combination of macroeconomic conditions, industry trends, and the company's strategic decisions. While the company has experienced significant revenue growth in certain segments, it is also facing challenges due to soft demand and broader economic conditions. The net income of the company experienced significant fluctuations between 2023 and 2026. Initially, it decreased by 60.5% from $135.7 million in 2023 to $53.8 million in 2024 due to various factors such as increased costs, decreased revenues, and lower average selling prices. However, there is a discrepancy in the provided data regarding the net income change between 2024 and 2026. According to one statement, it decreased by 23.6% from $70.4 million in 2024 to $53.8 million in 2026, while another statement mentions a decrease of 28.5% from $146.6 million to $104.8 million. The profit margins also underwent changes during this period. The adjusted EBITDA as a percentage of revenue decreased from 21.6% in 2024 to 19% in 2026, indicating a decline in profitability. Additionally, the gross profit margin decreased from 41.4% to 38.8%, and the operating expense ratio increased from 26.1% to 26.2%. These changes can be attributed to various factors such as increased costs due to tariffs and raw material price fluctuations, decreased revenues, lower average selling prices, and regulatory changes. The reasons for these changes in net income and profit margins are multifaceted and include economic downturns, recession, decreases in demand without corresponding cost decreases, prolonged unfavorable economic conditions or uncertainty, compliance with environmental regulations, and potential future liabilities. The company's ability to generate positive operating cash flow is a crucial indicator of its financial health. According to the provided information, the company has consistently generated net cash from operating activities over the past 3 years. In 2024, the company reported a net cash provided by operating activities of $154 million, indicating a strong performance in generating cash from its core operations. This figure is slightly lower than the previous year's result of $215 million, but still demonstrates the company's ability to generate positive cash flow. The most recent data available shows that the company generated net cash provided by operating activities of $139.5 million in 2026, which is a decrease from the previous year's figure. However, it is essential to note that this result is still positive and indicates that the company continues to generate sufficient cash from its operations. Overall, the data suggests that the company has been able to maintain a positive operating cash flow over the past 3 years, despite some fluctuations in the amount of cash generated. This is a promising sign for investors and stakeholders, as it indicates that the company's core operations are generating sufficient cash to support its growth and development. The company's financial health has undergone significant changes in recent years. One notable shift is the decrease in interest expenses, which have dropped by 25.8% between 2024 and 2026. This reduction in interest expenses is a positive sign for the company, indicating that it may be benefiting from lower borrowing costs or more efficient debt management. The company's debt level has also undergone changes, with a notable decrease of $79.6 million between December 28, 2024, and January 3, 2026. This reduction in debt is a positive trend for the company, suggesting that it may be paying down its obligations or refinancing its debt at more favorable terms. However, it's worth noting that the company's total debt level has increased to $640.7 million as of January 3, 2026, although this figure is not directly comparable to previous years due to a lack of data for earlier periods. Nevertheless, the decrease in long-term debt from $583.2 million to $538.8 million suggests that the company may be making progress in managing its debt obligations. Overall, while there are some mixed signals regarding the company's debt level and interest expenses, the overall trend appears to be a reduction in both areas, which is a positive development for the company's financial health. The financial performance of various regions and segments within the company has been mixed, with some areas showing significant growth while others experienced declines. The international segment stood out as a top performer, with revenues increasing by $30.3 million, 41.2%, from $73.6 million to $103.9 million. In North America, however, the picture was less rosy. Revenues decreased by $109 million, 12.1%, from $892.6 million to $783.6 million, with specific segments such as self-storage, new construction, and R3 experiencing declines of 26% and 9%, respectively. The shipping and handling segment also performed well, generating $35 million in product revenues and cost of revenues for 2024. The Janus International segment saw a similar increase in revenue to the international segment, with a growth of $30.3 million, 41.2%, from $73.6 million to $103.9 million. In contrast, the North America segment experienced an impairment of $0.30 related to ACT Business Unit trade name and terminal door operations, contributed only $7.30 in revenues and $0.80 in net income. The Janus International segment's adjusted EBITDA decreased from $2.2 million in 2024 to $11.6 million in 2026, indicating a decline in profitability. The performance of the Europe and Australia regions was not specifically mentioned in the provided summary, leaving their financial outcomes unclear. Management is cautious about the company's future developments due to various risks and uncertainties. However, they remain optimistic about growth opportunities driven by e-commerce expansion and a strong competitive position in growing markets. The company plans to invest in additional self-storage capacity and employee development to meet client demands and retain talent. To achieve growth, management intends to continue investing in key strategic objectives while closely managing cost structure. This includes acquiring companies that yield an acceptable internal rate of return and penetrating new vertical markets through innovation and significant investment in research and development. Management also emphasizes the importance of safety and environmental responsibility, as well as employee development and retention. They acknowledge potential risks associated with artificial intelligence, cybersecurity threats, and taxation-related issues, but see opportunities for benefits to the company. Overall, management's outlook is focused on growth through strategic investments, innovation, and talent development, while closely managing risks and uncertainties. The company has made significant investments through acquisitions to drive growth and revenue. One notable acquisition is the TMC acquisition, which contributed $7.3 million in inorganic revenue. This deal was documented across multiple pages, 35-38 of the report. Another major acquisition is the Kiwi II acquisition, a cash transaction worth $97.2 million that took place on January 8, 2026. This substantial investment highlights the company's commitment to expanding its operations and increasing revenue through strategic acquisitions. The company's financial activities have been notable in recent times. One key aspect is its decision to buy back shares, a move that has seen the company purchase a total of 1,925,242 shares. This indicates a commitment to returning value to shareholders through share repurchases. In addition to buying back shares, the company has also authorized and expanded share repurchase programs. Initially, $100 million was allocated for this purpose, but an additional $75 million was added later. These moves demonstrate the company's focus on maximizing shareholder value through strategic financial decisions. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. The steel industry's cyclical nature and uncertain future pricing trends pose a risk to availability, page 7. Tariffs on steel imports have increased from 25% to 50%, raising concerns about future tariffs and trade restrictions affecting raw materials and components, pages 11. Supply chain disruptions are also anticipated due to macroeconomic events, such as higher unemployment and shrinking demand for products, page 15. Global economic disruptions, including inflation, may impact demand and cause supply chain issues, page 19. Furthermore, climate change could affect the availability and cost of raw materials, commodities, and energy. Additionally, suppliers and distributors may become more conservative in response to economic conditions, leading to reduced inventories. Page 20. The company has already experienced a $15.7 million increase in provision for expected credit losses due to a change in estimate. Page 64. And raw materials inventory increased by $6.4 million, while finished goods inventory decreased by $1 million. Page 70. These concerns highlight the potential risks associated with inventory buildup and supply chain disruption, which could have material adverse effects on the business. That concludes the financial summary for Janus International Group Inc. Feel free to comment below, and I will be happy to answer them when possible.